Monthly dividend stocks are popular among income investors for obvious reasons. Oftentimes, dividend income investors stand opposed to dividend growth investors, but this doesn't have to be the case. In fact, some monthly dividend stocks also have phenomenal dividend growth and impressive dividend yields. In this video, we're going to look at monthly dividend stocks with the highest dividend growth rates available. Stay till the end because I'll be revealing the top growth monthly dividend stock on the market and its unique method of generating returns for investors. Let's jump right in and talk about the top monthly dividend growth stocks. Gladstone Investment Corporation, or GAIN, is a publicly traded business development company that invests in small and medium-sized companies in the United States. Founded in 2005 and based in McLean, Virginia, the company specializes in providing debt and equity financing to lower middle-market businesses with revenues of $20 to $100 million. GAIN's investment strategy is focused on providing growth capital to companies that operate in attractive markets and have strong management teams. The company typically invests in companies that have a history of profitability and generate positive cash flow. GAIN's investment portfolio is diversified across a range of industries, including manufacturing, business services, healthcare, and consumer products. In addition to its primary investment activities, GAIN also offers advisory services to its portfolio companies. These services include strategic planning, financial modeling, and operational improvement. One potential risk for GAIN is the impact of economic cycles on its portfolio companies. Lower middle market businesses may be more vulnerable to economic downturns, and a recession could potentially result in defaults or write-offs of some of GAIN's investments. However, the company's management team has a track record of successfully navigating economic cycles and managing risk. Gladstone currently yields a 7.1% dividend on a $13.55 share price. Curiously, the dividend yield has decreased over the past 7 years from 11% to 7.1% due to the increase in share price from $6.79 in 2016 to the current share price of $13.55. GAIN has a 5-year dividend growth rate of 3.4% and has increased its dividend 9 of the past 10 years. Payout ratios from net income have remained below 65% for the past 9 years, although they did report negative net income during 2 of those years. Net income, cash flow, and free cash flow have all been increasing at about an 11% rate for the past 10 years. Although these income metrics have been increasing, there are also numerous negative earnings reports over the past 10 years, especially in free cash flow and operating cash flow. GAIN's attractive initial yield and monthly distributions may entice investors, but a word of caution is warranted. The negative earnings reports are particularly concerning for me and makes me wonder how the company has been able to consistently increase its dividend over the past 10 years. The current interest rate environment may also be a significant headwind for future growth and may threaten the dividend. Next is SABA Capital Income and Opportunities Fund, BRW. BRW is a closed-end fund managed by SABA Capital Management. The fund primarily invests in a diversified portfolio of fixed-income securities, including corporate bonds, high-yield bonds, and collateralized loan obligations, or CLOs. BRW seeks to provide investors with attractive income generation and capital appreciation opportunities through active management of its investment portfolio. One of the unique features of BRW is its ability to invest in the equity and debt securities of closed-end funds. Closed-end funds are investment companies that issue a fixed number of shares and trade on an exchange like stocks. These funds can offer attractive opportunities for value and income generation, but may also be subject to liquidity and pricing risks. BRW's investment approach is designed to take advantage of market inefficiencies and opportunities. The fund's management team has a deep understanding of the fixed income markets and seeks to identify opportunities for value creation and income generation across market cycles. The fund employs an active management approach and has the flexibility to invest across the capital structure, including senior secured loans, mezzanine debt, and equity. One potential risk for BRW is the impact of interest rate fluctuations on its fixed income securities. Rising interest rates may lead to a decrease in the value of the fund's portfolio and lower income generation. However, the fund's management team has a track record of successfully navigating interest rate cycles and managing risk. BRW currently yields a 13.4% dividend with a 5-year growth rate of 13.1%. The fund has only been paying a dividend for the past 6 years and has cut their dividend once during that time. Payout ratios have been all over the place, climbing as high as 436% and dipping as low as 4% when they've reported positive earnings. Over the past 6 years, BRW has had 3 negative earnings reports and stated negative income across all metrics in Q1 of 2023. Net income has declined 16.7% over the past 6 years, and earnings per share has declined 15.7% over the same time period. Free cash flow and operating cash flow have also taken nosedives over the past 3 years. Overall, this fund looks like it's in deep trouble. Although the initial yield is attractive, the income reports and erratic payout ratios throw major red flags. Plus, the fund recently more than doubled its dividend from 48 cents per share to $1.03 per share, which screams yield trap. Sabine Royalty Trust, SBR, is a publicly traded trust that holds a net profits interest in the oil and gas production from properties located in the United States. The trust was established in 1982 and is based in Dallas, Texas. The trust's holdings include working interests in various oil and gas properties located in Texas, Louisiana, Mississippi, New Mexico, Oklahoma, and other states. SBR receives royalties from the production of oil, natural gas, and natural gas liquids from these properties. The trust's income is derived from the sale of these commodities as well as lease bonus payments, rental income, and other sources. SBR's income is distributed to unit holders on a monthly basis, with the amount of each distribution determined by the net proceeds received by the trust. The trust has a long history of consistent distributions to its unit holders, making it an attractive option for income-oriented investors. One potential risk for SBR is the volatility of commodity prices. The trust's income is directly tied to the price of oil and gas, which can be subject to fluctuations based on supply and demand, geopolitical factors, and other factors. However, the trust's long-term history of consistent distributions suggests that it's been able to navigate these fluctuations and continue to provide income to its unit holders. SBR currently yields a 12.1% dividend with an $8.53 share price. The 5-year dividend growth rate is an impressive 20.2%, although most of that growth has come over the past 2 years, increasing from $2.18 in 2021 up to $8.41 in 2023. This increase has come alongside massive spikes in net income, operating income, and earnings, so the sudden growth shouldn't throw any alarms as SBR's dividend policy is directly tied to the performance of oil and gas sales. As a trust, payout ratios are necessarily high, hovering right around 100% for each reporting period. Net income, operating income, and earnings have all grown steadily at an 8% pace since 2014, and SBR has not reported any negative income over the same time period. I'm intrigued by trusts, especially ones like Sabine Royalty because of their direct link to the commodities market. It always sets me on edge when a company sells products that aren't grounded in something real, for instance, MREITs or BDCs. SBR's high payout ratios don't concern me since they're a trust, and the increase in income metrics has me optimistic about the future prospects of the dividend distributions and the company as a whole. Last on our list is San Juan Basin Royalty Trust, SJT. SJT is a publicly traded trust that was created in 1980 to collect and distribute royalty payments from oil and gas wells located near the San Juan Basin of New Mexico. The trust is managed by Bank of America, and the units of the trust are listed on the New York Stock Exchange. SJT collects a royalty on oil and gas produced from certain properties in the San Juan Basin. The royalty payments are made to SJT by the operators of the properties and are then distributed to the trust's unit holders on a monthly basis. The amount of the royalty payments received by SJT and distributed to unit holders is based on the net proceeds from the sale of oil and gas from the properties, minus certain expenses and reserves. One of the key advantages of investing in SJT is the potential for regular income. As a trust, SJT is required to distribute all of its taxable income to unit holders, which means that investors can potentially earn regular income through dividend payments. Additionally, the trust's royalty payments are tied to the production of oil and gas, which can be an attractive investment opportunity for those seeking exposure to the energy sector. San Juan Basin Royalty currently yields a massive 29.2% dividend with a 5-year growth rate of 21.5%. Like SBR, most of this growth has come over the past 2 years, rising from 23 cents per share in 2021 to $1.66 per share in 2023. Like SBR, payout ratios are 100% of net income, consistent with their trust status. Net income and earnings have seen steady 2% growth since 2014 and have taken off since 2021, which explains the exponential increase in dividend payouts. There seems to be a huge growth wave in oil and gas trusts at the moment. Both of the highest dividend growth stocks are trusts focused on oil and gas production, and their sales don't seem to be slowing. From mid-2020 to early 2022, crude oil and natural gas saw massive price increases. Natural gas has definitely cooled down since mid-2022, but crude oil remains somewhat elevated compared to prices in the 2010s. This transitory spike in oil and gas prices explains the larger dividend distributions from these companies, but the question still remains. Are these prices sustainable, or will sales and dividends be cut? Monthly dividend stocks are particularly interesting for income investors because of the potential for regular income. However, dividend growth is still very important for investors looking at the long-term viability of their investments. We looked at the highest monthly dividend growth stocks and briefly analyzed their financial standing and the security of the dividend, but be sure to do your own research if you plan on buying any of these stocks. Make sure you subscribe and turn on notifications for more weekly videos on dividend stock analysis and dividend investing strategies. If you enjoyed the video, make sure you drop a like and leave a comment to let us know what you think. Thanks so much for watching. Until next time, stay safe and take it easy.